Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're taking a snapshot of the US Treasury and fixed income markets. And my guest is Adam Abbas, Portfolio Manager and Co-Head of Fixed Income at Harris Associates. 2023 billed as the year of the bond, when a Fed pivot away from rate hikes plus the danger of a hard landing for the economy would push yields lower, bond values higher. Only look at those yields now. The 10-year US Treasury, where yields this month got close to a 15-year high, as investors bet on a softer landing and that US rates, though possibly topping out, may stay elevated for some time to come. And there's been more pressure on yields too in both directions, from tighter monetary policy at the Bank of Japan, Fitch's downgrade on the US economy, and Moody's downgrade on US banks, while in the background there's the prospect of the US budget deficit soaring, according to Fitch, over the next couple of years. So bond investors might be forgiven for not knowing where to turn, or indeed for turning to US stocks for the surprising returns seen there year to date. Well, with me now is Adam Abbas, Portfolio Manager and Co-Head of Fixed Income at Harris Associates. Welcome, Adam. Many thanks for joining us. The Fed, at its last meeting, renounced its forecast of recession this year. The only way for Treasury yields must be up on the back of that decision, mustn't it?
Let me frame this a bit. In the short run, you're absolutely right. You have bears really focused on talking about the large amount of upcoming supply, the deficit, and the related overhang there. And some of the I'll add one, structurally sticky labor dynamics. And on the bull side, however, you see that party focused on the disinflationary impulse. Now, really in a matter of 6-7 quarters, we have gone from a zero interest rate world to 4 to 5% risk-free rate world. And that means the average US Treasury could see orders of magnitude higher moves and still break even versus the prior decade. We also have better real rates, now positive 1 to 2% across most of the curve. And finally, Treasuries are starting to protect risk assets, starting to revert to more negative correlations to stocks and other risk assets. So you have a better carry, you have better downside protection with break evens, and you are returning to bonds having a solid place for diversification within a portfolio. And we've really it's been a decade-long hiatus from when we had all three of those aligned.
So more recently, though, one noticeable feature of the markets has been the inverted yield curve, a traditional warning sign of recession. How does that fit into your outlook?
It's historically a very accurate signal. It doesn't have to imply a big downturn on the horizon, although we do expect a slowing of the economy. I think people should focus more importantly on CPI, core CPI, how it is coming down. Does it continue that trajectory lower? And labor markets, which will be drivers of how the curve normalizes over time. If we get CPI to come down smoothly and we get below the 3% handle, and the labor market doesn't break down through this process over the next 12 months, we could get a slow normalization of the curve without a hard slowdown in the economy.
Well, with that normalization of the curve, where do you see the long end playing out against the short end? And are we seeing a return of steepening trades into the market?
I think moving out the curve, if you are on the short end today, makes a lot of sense. If you're in a balanced portfolio, especially, you can serve a dual purpose of protecting risk assets in a broader portfolio if the economy ends up having a harder landing into a recession through superior total returns through duration, or if inflation comes down. And I think we really like the belly of the curve is to kind of be at the intersection of having a little bit of protection from risk assets if we slow down further, having a little bit better carry, and not as much reinvestment risk as that front end today.
Well, another noticeable feature of the markets this year has been the wide gap in sentiment between stocks. I mean, we've seen a rise of 40% in the NASDAQ so far year to date. So the sentiment between stocks and between bond markets, what do you discern in that? Is it a warning sign of any form?
If you look at under the hood of the S&P 500 and see where most of the return has been over the last 12 months, and then you actually disaggregate the names that have not participated in that rally, the multiple actually looks fair value to even cheap. And especially in the names we look at here at Harris, the value names, you'll see even steeper discounts that are more aligned to it with kind of the bond market's telling you in certain areas. So I would say that the point here for me is It just depends on where you look. I would really encourage people to stay away from relying heavily on index level data because of the concentration in a lot of these indices. Pick active managers who understand what's going on with each of these constituents, because there is a lot of dispersion on the surface.
Okay, Adam, it's been great to hear your thoughts today. Adam Abbas, Portfolio Manager and Co-Head of Fixed Income at Harris Associates. Many thanks for being with us. And that is your roundup of the US Treasuries and fixed income markets. I'm David Pollard, and this is Reuters.